Hello everyone, this is the quiz review video for your quiz on perpetual inventory records, which is chapter 6 on Pearson. Before we get started, it's really important that you understand the three different cost flow assumptions. They are FIFO, LIFO, and AVCO. FIFO is the first in, first out assumption, and it assumes that the oldest piece of inventory that you have is always sold first. We're going to have goods, a lot of stores I should say have goods that you can't track easily. Like think about corn at your grocery store. It's really impossible when someone comes up to your register and buys a piece of corn for you to know when exactly that can was purchased and at what price it was for. You probably have a whole lot of different cans of corn on there that were purchased on different dates, and they probably had different purchase prices. It would be impossible to track can per can exactly what it cost you. So you're going to make an assumption, and if you're using the first in, first out or FIFO assumption, you assume that every item that comes up is the oldest one of that particular item type, in our case cans of corn, that you have in your inventory. The opposite of this is LIFO, where you're going to assume that every time a unit of inventory is sold, that it is the last one that you purchased. So it's the newest piece of inventory that you had. And then finally, AVCO. Whenever a piece of inventory is sold, you assume that its cost, what you're going to use to calculate your cost of goods sold on the sale, is the average cost of all units of that type that you have. Let's look at this in a practical example. Let's say that Golf Craze has two sets of backspin golf clubs in inventory. One of these sets was purchased on January 1st for $400, and the other set was purchased on January 15th for $420. We can't tell these apart. So when someone comes up and they bring a bag of these backspin golf clubs, we have no idea to tell if it's a January 1st purchased one or the January 15th purchased one. So we make an assumption. And our three options are FIFO, LIFO, and AVCO. Well, under FIFO, what happens? When we make this sale, we assume it's our oldest piece of inventory of this particular type. What is the oldest set of backspin golf clubs that Golf Craze would have? It's the ones that they purchased on January 1st for $400. So when they record the cost of goods sold on that sale, they assume it's the oldest bag, and they record the COGS at $400. Under LIFO, they assume it's the newest piece of inventory. Well, what's the last one that we purchased? It was on January 15th. We bought another set for $420. So when they made this sale, they are going to assume that it is the $420 set of backspin golf clubs that were purchased on January 15th. And under AVCO method, the weighted average method, they assume that all of the inventory that they have of that particular type, in this case these golf clubs, is being carried at the average cost they paid to buy it. So if they bought one bag for $400 and they bought another bag for $420, the average cost of that would be $410, and that would be the cost of goods sold that they reported. The thing that lets you track this much easier than it would be by just doing calculations is called a perpetual inventory record. And you're going to keep one of these for each distinct item that you have in your inventory. In our example, Lazy Lighting, during the month of November 20XX, is going to keep track of transactions related to inventory item number 46, which is their lava lamp. We're given what they begin with and all of the sales and purchases that they made for this particular unit of inventory. So we start our perpetual inventory record by filling in the method. It is the FIFO method. Its item number is 46, and its description is that it's lava lamps. For our beginning balance on November 1st, we're going to place that into our inventory on hand, because that's what we have on hand when the month starts. What do we have? We have 20 lava lamps. Each one has a unit cost of $50, which means the total cost that Lazy Lighting paid to acquire those lava lamps was $1,000. On November 5th, we're going to sell 10 lamps. So November 5th, sales go under the cost of goods sold section. For our quantity column, we're selling 10, and under the FIFO method, we assume we're going to sell the oldest piece of inventory that we have first. Well, it doesn't matter right here because they all have the same unit cost, and that unit cost is 50, which means their total cost is 500. So they had 20 lava lamps, and they sold 10 of them, which means their inventory on hand after the sale on November 5th is going to be 10 lava lamps. All of those lava lamps had a unit cost of 50, which means that the inventory on hand, the 10 lava lamps they have remaining, has a total cost basis of $500. On November 10th, they're going to make a purchase, and they're purchasing 15 lava lamps. at a unit cost of $60 a piece for a total of $900, which you're going to report in the purchases section of your perpetual inventory record. If you're using FIFO or later LIFO when we get there, you can't just merge all your inventory together. You can't say we had 10, we were just buying 15, so let's say we have 25 units of inventory on hand. What you have to do is create what they call layers. We're going to keep an individual record from each purchase that we had so we know what our oldest inventory is. To do this, bring down everything you have already. Well, what do we have first? We have those 10 $50 lava lamps with a total cost basis of $500. That's going to be our first layer. Then we're going to add a new layer for our new purchase. What did we just purchase? We purchased 15 lava lamps. It's $60 a piece, and the total cost of that purchase was $900. So yes, we have 25 lava lamps, but we're carrying them in two separate layers, the $50 lava lamps and the $60 lava lamps. On November 15th, we're going to make a sale, and we're selling 5 lava lamps, so let's report that under the quantity section, under cost of goods sold. How much is our unit cost for the ones that we're selling? Well, we're using FIFO. So the oldest inventory gets sold first. What is the oldest inventory that we have on our books for lava lamps? It is the $50 lava lamps that we started the period with. So when we make this sale, we're going to assume that all 5 that were sold were our oldest lava lamps in inventory, which were the $50 ones, and record our cost of goods sold on the sale as $250. What do we have left? Well, we had 10 $50 lava lamps, but we just sold 5 of them. So we have 5 $50 lava lamps left, and our cost basis for those lava lamps is going to be $250. Just take quantity and multiply by unit cost. And we still have all 15 of the $60 lava lamps for a total cost basis of $900 for that layer. On November 20th, we're going to make another purchase. We're buying 10 lava lamps. They cost $65 a unit, so our total cost is $650 for that particular purchase. Again, we're making a purchase, so we need to make a new layer in our inventory. Bring down what we had. We had 5 $50 units with a total cost basis of $250. We also had 15 $60 lava lamps with a total cost basis of $900. And now we're going to make a new layer for our purchase on November 20th of 10 lava lamps with a $65 unit cost, meaning our total cost basis for that particular purchase on our books is $650. Now on November 30th, we're going to make one more sale, and our sale is of 20 lava lamps. How are we going to get the 20 lava lamps? Well, we need to sell from our oldest inventory first. So our oldest inventory is still those $50 lava lamps that we began November with. Let's sell all 5 of those that we have left on our books. They have a unit cost of $50, meaning that's going to be a $250 cost of goods sold for those 5 lava lamps. So we're not just selling 5, we're selling 20, which means we need to take the 15 next oldest, if you will, lava lamps off of our books. Well, conveniently, that's the size of our second layer. So let's sell all 15 of our $60 lava lamps and report a cost of $900 on those. And since we sold 5 $50 ones and 15 $60 ones, that's a total of 20 that we sold, which is equal to the size of our sale. What do we have left? Well, we sold all of the $50 lava lamps. We sold all of the $60 lava lamps. So all we have left at this point after this November 30th sale is 10 lava lamps, which cost us $65 a piece. So we have a total cost basis in our inventory of $650 for that one and only layer. Next, we have to report our totals, and we only report totals for the quantity and total cost sections of our quantity and total cost columns of our 3 different sections. So for our quantity of purchases, we purchased 15 on November 10th and 10 on November 20th, which means we purchased 25 units. What was our costs? Add together the total cost column. We paid $1,550 for those units. How many units did we sell? Add together the quantity of the total of your quantity column under cost of goods sold. We sold in total 35 lava lamps, item number 46, during the period. And the total COGS that we reported from the sale of these lava lamps is going to equal $1,900. For inventory on hand, you don't total up. Why? Because think about it for a sec. I don't know what that adds up to, but if we added up the quantity column of our inventory on hand, that's well over 100. Do we have 100 lava lamps in inventory right now? We don't. What do we have? we have just what we reported on the last line. We have 10 lava lamps with a total cost basis of $650. So for the purchases and cost of goods sold section, total together quantity and total cost. For inventory on hand, just bring down what you had left after your last transaction. Making this table will help you record your entries. So on November 5th, what happened here? Well, we got our first entry, which is going to record the revenues from the sale. We're selling 10 lava lamps on account for $110 each, which means since it's on account, we're going to debit accounts receivable for the total amount of money that our customer is going to owe us. Since we're selling 10 lava lamps at $110 a piece, they're going to owe us $1,100. We're going to record that as the amount of sales revenue that we had on the transaction. We have no discounts right here, we don't need to worry about it. What happened here is we sold inventory on account. On November 5th, we got to record the expense. And when you record the expense, the debit is always the cost of goods sold. What's our cost of goods sold going to be for? Well, we can go and we can find it on our perpetual inventory record. On the November 5th sale, we recorded total cost of goods sold is $500. Let's throw that in our journal entry. What has to decrease? The inventory that we sold. So we're going to credit merchandise inventory to decrease the carrying value of that account by that same $500, and we recorded our COGS on sale. On November 10th, we're purchasing 15 lava lamps for $60 each. Well, since we're purchasing inventory, we need to increase the value of our inventory account, and since inventory is an asset, it's going to increase with a debit, so we're going to debit merchandise inventory for $900. And our credit is going to be to our payment method. It's on account, so it's going to be accounts payable, getting credited for $900. We purchased inventory on account. On November 15th, we made another sale. We sold 5 lava lamps on account for $110 each. So November 15th, we're going to debit accounts receivable one more time. How much do they owe us? Well, we sold 5 at $110, which means it's $550, and that is the amount of sales revenue that we are going to record. So let's credit sales revenue for $550. And once again, we sold inventory on account. When we record the expense, we always start by debiting cost of goods sold to increase our expense account related to sales. How much are we going to debit cost of goods sold for? One more time, back to our perpetual inventory record, and we see that on November 15th, we recorded a total cost of goods sold of $250. So let's credit COGS for $250. And let's decrease the value of our merchandise inventory by crediting it by that same $250. We recorded COGS on sale. On November 20th, we purchased 10 lava lamps, and we did so at $65 each. Well, same entry we had before. We're going to debit merchandise inventory for the total cost of this purchase, which our perpetual inventory record tells us was $650. And we're going to credit accounts receivable for that same $650. We purchased inventory on account. And then lastly, on November 30th, we sold 20 lava lamps on account. We did so for $110 each. So on account, we debit accounts receivable. How much? Well, it's 20 at $110 a pop, which means our sale was for $2,200. That's what our customer owes us. That's what we are going to increase our accounts receivable account by, and that's what we're also going to increase our sales revenue account by. So debit to AR, credit to sales revenue for $2,200 to record the sale of inventory on account. For the expense portion of this sale, we're going to once again debit cost of goods sold. How much? Let's go back to our record. We had 5 $50 units with a total cost basis of $250. We had 15 $60 units with a total cost basis of $900 that we sold. So in total, the cost that we're going to report as our cost of goods sold is equal to the sum of those two numbers. $1,150 is going to be our COGS for the November 30th sale. And we're going to credit merchandise inventory for that same amount to decrease our inventory. $1,150, we recorded our COGS on sale. For the LIFO method, we're going to repeat the same process that we had, but now we have one big difference. Instead of assuming that our oldest piece of inventory is getting sold first, we're going to assume that our newest piece of inventory is getting sold first. So our method is LIFO. It's still inventory item 46, and our description is that it's a lava lamp. On November 1st, let's put our beginning balance of inventory for lava lamps on our books by filling in our inventory on hand section. With our beginning balance, we have 20 $50 lava lamps with a total cost of $1,000. On November 5th, we are selling 10 of these. And we're assuming that we're selling the last purchased ones. Well, we only have one type, so our cost basis for these ones that we're selling has to be $50, which means the total cost of goods sold we're going to record on the sale is $500. We had 20, we sold 10. We're down to 10 units left in inventory. They all have a unit cost of $50, which means their cost basis is $500. On November 10th, we're going to make a purchase of 15 lava lamps at a cost of $60 per lava lamp, and in total that purchase is going to cost us $900. Just like FIFO, we have to layer our inventory. Bring down what you have first. We have 10 $50 units with a total basis of $500 that were on our books already, and we just made a purchase of 15 more with a $60 unit cost for a $900 basis. We're going to create a separate layer to record that. So 15 $60 lava lamps, total cost of $900. On November 15th, we're going to make a sale of 5 lava lamps. How much are they going to cost us? This is LIFO, so we assume that we're selling the last purchased inventory first. Well, what is the newest inventory that we have for lava lamps? It's the 15 $60 lava lamps that we just purchased on November 10th. So our unit cost under the LIFO method will be $60 on the sale, which means we're going to record cost of goods sold of $300. What inventory do we have left still? We still have all 10 of those $50 lava lamps that we started the month with. And we had 15 $60 lava lamps, but we just sold 5 of them. So we have 10 $60 lava lamps left on our books, and the total cost basis that Lazy Lighting has for those lava lamps left over from the November 10th purchase is $600. Let's put that there. On November 20th, we're going to make another purchase. We're buying 10 lava lamps. The unit cost of those lava lamps is $65, which means that our total cost of that purchase was $650. Let's bring down the inventory that we had first. We have 10 $50 lava lamps, total cost of $500. We have 10 $60 lava lamps with a total cost of $650. And we just made a purchase of $65 lava lamps that we're going to make a new layer for. So let's add our 10 $65 lava lamps with a total cost of $650 to our inventory layers. Now on November 30th, when we make a sale of 20, we're going to sell our newest inventory first. So how much did the last purchased lava lamps cost us? They cost us $65 a piece. Let's sell all 10 of those at $65 a pop to get to $650. But we're selling 20, so we got to sell our next newest, which is the $60 ones that we purchased on November 10th. And we have 10 of those on our books. Well, conveniently 10 plus 10 gets us to the 20 that we are selling. They have a unit cost of $60 for a total cost of $600. What is left for lava lamps on our books after we make the sale? All we have left are the 10 $50 lava lamps with a total cost of $500 because we sold all of our $65 lava lamps and all of our $60 lava lamps. Just like we did before, let's figure out our total quantity purchased. We purchased 25 units. The total cost of those 25 lava lamps was $1,550. This is exactly the same that we had on FIFO, and the reason is the cost of purchases doesn't change based on what cost flow assumption you're using. The only thing that's going to change is your cost of goods sold and your inventory on hand at the end of the period. Yes, we still sold 35 lava lamps, but now we recorded a total cost of goods sold from these lava lamp sales is $2,050. And for our inventory on hand at the end of the period, all we've got left is 10 lava lamps, which we're going to report on our books as having a cost basis of $500. The journal entries are incredibly similar. We're going to follow the same exact steps. On November 5th, we sold 10 lava lamps on account for $110 each. So November 5, we're going to debit accounts receivable for the total amount of money, which was $1,100. We're going to credit sales revenue for that same amount, $1,100. We sold inventory on account. On November 5th, we're going to record the expense for this by debiting cost of goods sold and going to our perpetual inventory record to see what we recorded as a total cost for our November 5th sale, and it was $500. We're going to credit merchandise inventory for that same amount to reduce the inventory we have on our books because we sold some of it, and we recorded COGS on sale. On November 10th, we purchased 15 lava lamps for $60 each. So We're going to debit merchandise inventory for the total cost of that purchase, which we can see from our perpetual inventory record was $900. And we're going to credit accounts payable because we're buying on account for that same amount. We purchased inventory on account. On November 15th, we're going to sell 5 lava lamps on account for $110 each. Recording the revenues, it's on account, so it's still a debit to accounts receivable. For the total amount of cash we expect to receive, we're selling 5 at $110, means it's $550. And that is the amount of sales revenue we're going to record, also $550. We sold inventory on account. And then on November 15th, we're going to record the expense portion. It's always a debit to cost of goods sold. Let's go to our perpetual inventory record and see what we put as our total cost of goods sold for our November 15th sale. It was $300. So let's decrease merchandise inventory by that same amount. And once again, we're going to record COGS on sale. On November 20th, we're purchasing 10 lava lamps, and we're doing so at $65 each. So let's debit our merchandise inventory account to increase it by the total cost of that purchase, which was $650. And let's credit accounts payable for that same amount, which is $650. We purchased inventory on account. And then on November 30th, one last sale. We sold 20 lava lamps for $110 each. So accounts receivable is going to be our debit for the total amount of money, which is going to total $2,200. We're going to record that same amount of sales revenue by crediting sales revenue for $2,200, and we sold inventory on account. And then for November 30th, let's record the expense portion of that by debiting cost of goods sold. We'll go to our perpetual inventory record and see what we have. Well, we sold all of our $65 units. We sold all of our $60 units. In total, the total cost, if you add those together, was $1,250. Let's credit merchandise inventory for that same amount, $1,250, and we recorded COGS on sale. So you may have noticed as you're going through, for every sale that we made and every purchase that we made, the entry was exactly the same as FIFO, and that's true. The only thing that's going to change is the expense portion of your sales entry. So cost of goods sold and merchandise inventories, debit and credit in the second one of these entries, is going to change depending on your method, but sales is always going to be exactly the same. Our last method is AVCO, and the weighted average method runs a little different than FIFO and LIFO, namely because we don't need to layer our inventory because we're assuming that all the inventory we have is being carried at the average cost of all of that type of inventory. So to fill in our perpetual inventory record, we still need the method. We're AVCO. Our item number gets filled in, and then we have our description, which is lava lamps. We're still going to have a beginning balance reported in our inventory on hand section of 20 units with a $50 unit cost for a total cost of $1,000. On November 5th, when we make a sale, we're going to sell 10 units, and we're going to sell them at the last known unit cost that we had. Well, that's $50, which means the total COGS that we're going to record on this sale is $500. What do we have left? We have 10 units. Their unit cost is $50 for a total cost basis of our lava lamps of $500. Next up, on November 10th, we're going to make a purchase, and we're purchasing 15 lava lamps. The unit cost was $60 per lava lamp, so our total cost is $900. And this is where the difference between AVCO and both LIFO and FIFO becomes really evident. Instead of layering, we're going to bunch our inventory together. We had 10 lava lamps. We're buying 15 more, which means in total we're going to have 25 lava lamps. The lava lamps we did have before had a cost basis of $500. We just spent an additional $900 on this newest purchase, which means our total cost for all of our lava lamps in inventory is $1,400. How do we find our unit cost? Well, we simply take our total cost of $1,400, divide it by our quantity of 25 lava lamps, and it gives us our new unit cost, which is going to be $56. So we're going to report that as our unit cost. Next up, on November 15th, we're going to make a sale, and we're making a sale of 5 lava lamps. When you make a sale under AVCO, you always assume that you're selling at your last known unit cost. Well, our last known unit cost is $56, which means the COGS that we're going to record on the November 15th sale is $280. We had 25 units, we just sold 5 of them, which means we have 20 left. When you make a sale under the AVCO method, your unit cost does not change. You can just bring it down. It's still 56. And to find your total cost, take your quantity, multiply it by your unit cost of 56, gives you your total cost, 1,120. On November 20th, we're going to make a purchase of 10 units. They cost $65 a piece, so our total cost is $650. Well, we had 20 before, we just bought 10 more, which means now we have 30. Our cost of the units we had in inventory before this purchase is $1,120. We just spent another $650 to buy more units, which means our total cost of all of our lava lamps is increasing to $1,770. Now we need to figure out our new unit costs. So we take our new total cost of $1,770, we divide it by our quantity, 30 lava lamps, means that each lava lamp that we have in inventory has an average cost of $59. So we're going to report that as our unit cost. And then when we make a sale on November 30th, we're going to sell 20 units, and we're going to sell them, because we always do an AVCO, at the last known unit cost, which was 59, which means our total cost is going to be our quantity times our unit cost of 1,180. We had 30, we sold 20, means we have 10 left. Unit cost does not change on a sale in the AVCO method, which means it's still 59. And if we multiply that out, it means we have $590 worth of inventory left on hand. So for our totals, we still purchased 25 at a cost in total of $1,550. Hasn't changed from any of our methods. 35 is the amount of lava lamps we sold during the period. Using the AVCO method, we're going to record a total cost of goods sold of $1,960 on these purchases. And our quantity of inventory on hand is still 10 lava lamps, but using this method, we're going to report them at a cost of $590. For our entries, one more time through, on November 5th, we sold 10 lava lamps on account for $110 each. We're going to make the same entry we have been making. Debit to accounts receivable for $1,100. Credit to sales revenue for $1,100. We sold inventory on account. Also on November 5th, we're going to record our expense with a debit to cost of goods sold. We're going to go to our perpetual inventory record and figure out what our total cost was of that November 5th sale. It was $500, and we're going to decrease merchandise inventory by that same amount. We recorded COGS on sale. For our purchase on November 10th, when we purchased 15 lava lamps for $60 each on account, that cost us a total of $900, which we're going to debit to merchandise inventory because inventory is always carried at cost. And we're going to credit accounts payable for that same $900. We purchased inventory on account. On November 15th, we're going to sell 5 lava lamps on account for $110 each. So we record the revenues by debiting accounts receivable for the total amount of the sale, which was $550. And we're going to credit sales revenue for that same amount to record our sale of inventory on account. When we record the expense portion of this, we're going to once again debit cost of goods sold, go to our perpetual inventory record, and see that using the AVCO method on November 15th, when we made the sale, we're going to record $280 worth of cost of goods sold and decrease merchandise inventory by that same amount. We recorded our COGS on sale. And November 20th, when we purchased 10 more at $65 a piece, we're going to take that $650 purchase and put it into our inventory by debiting merchandise inventory for $650 and putting a payable on our books for that $650 that we owe our vendor. We purchased inventory on account. And then lastly, on November 30th, we got one more sale. Recording the revenue is a debit to accounts receivable for the total amount of the sale, still $2,200. We credit sales revenue for that same amount. And when we record our expense, we're going to debit cost of goods sold. We're going to go to our perpetual inventory record and see what cost of goods sold was for our November 30th sale. It was $1,180. And we're going to decrease merchandise inventory by that same amount to record our cost of goods sold on the sale of inventory. So I know you're probably thinking this is kind of crazy, and it is. Accounting is a very nuanced subject of study. For FIFO, LIFO, and AFCO, we have the choice of what method we want to use. Well, how do you choose? Well, let's see how this affects our numbers at the end of the period, and we're just going to do it related to just this particular item, lava lamps, but same concept is going to apply for all of our inventory. Our revenues, on November 5th, we sold $1,100. We received $1,100 for our sale of lava lamps. On November 15th, we sold $550 worth of lava lamps. And on November 30th, we sold $2,200 worth of lava lamps, which means our revenues are $3,850. And as we saw from our journal entries, revenues don't change depending on what method we do. So we got $3,850 of revenues regardless if we choose the FIFO, LIFO, or AFCO cost flow assumption. Our cost of goods sold, however, was different under every method. Let's look at our FIFO perpetual inventory record. Our total cost of goods sold using this FIFO assumption was $1,900, found on the very bottom line of your perpetual inventory record as the total cost in the cost of goods sold section. Gross profit is revenues minus COGS, which means if we had $3,850 worth of revenues and we're reporting our COGS as $1,900 using FIFO, we're going to have gross profit of $1,950. Our ending inventory on our FIFO table, as we can see in the very bottom right hand corner, is being carried at a total cost of $650. That's the amount of inventory that we would report for lava lamps on our balance sheet. How does this change to LIFO? Well, on our LIFO table, our cost of goods sold total was $2,050, meaning we would have gross profit of $1,800. Our ending inventory on our LIFO table had a total cost of $500. So LIFO made us have a higher cost of goods sold, but a lower ending inventory. And then lastly, for AVCO, we reported a total cost of goods sold of $1,960. Our gross profit of $3,850 minus $1,960 would be $1,890. And our ending inventory would be reported as $590, the total cost of our inventory on hand. So how do these differ? Well, if we use FIFO, it's going to give us the highest reported value of inventory, but the lowest cost of goods sold, and subsequently, because we have the lowest expense, the highest amount of gross profit. If we use LIFO, we're going to have the lowest amount of inventory, but the highest cost of goods sold, which means the least amount of gross profit. And then AVCO are going to give us numbers somewhere in the middle between FIFO and LIFO. Companies have their option of choosing any three of these methods. Which one do they choose? It depends on what the company wants. If the company wants to report as much inventory as possible because they want to use it as collateral for a loan, well, they'd want to choose the FIFO method because it gives you the highest ending inventory. LIFO gives you the lowest gross profit, and people are probably looking at this and saying, all right, LIFO's terrible. It has the lowest gross profit and it has the lowest inventory. Why would somebody want to use this? Well, what do companies have to pay on their profits? They have to pay taxes. So using the LIFO method, sure, it gives you the biggest expense. You report the least amount of income and you report the lowest amount of inventory, but you pay the lowest amount of tax, which is why LIFO is by far the most popular methodology that people use. Like, LIFO is used by about 90% of American companies. And I said American companies, which is a very important note because LIFO is only legal in America for that very reason. Governments don't like it when people pay the least amount of taxes they can. So pretty much everywhere else in the world has banned the use of LIFO. We're the last remaining bastion of LIFO users. I don't see that changing. AVCO reports in the middle. So if you wanted to lower your taxes a little bit but still have, a respectable amount of inventory to show, you would choose the AVCO method. And AVCO is used everywhere in the rest of the world because they can't use LIFO. So this is a weird concept, and you're probably looking at this and saying, all right, the numbers are changing, but nothing of substance is changing. We still bought the same amount of units, we still sold the same amount of units, we still had the same amount of sales revenue, and we paid the actual total cost for this. Why are we reporting different numbers? We are reporting these different numbers because that's our accounting income, and accounting income is not the same as cash. It's not this, like you and I think of our income as the amount that goes into our bank account, because that's the actual amount of cash we receive. But for accounting purposes, think about it more like taxes. You can claim a whole bunch of stuff on your taxes that you don't have to pay taxes on. That's what companies are doing right here. They're changing around the numbers they report to fit the things that they want. So accounting income isn't the same as actual cash. It's more of a concept. And we're going to get into this more as the semester goes on, but for now, I wish you the best of luck on your quiz. Take care.